Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden meanings behind corporate filings, and as you may have guessed by that little hint of what's to come, today we are diving deep into the financial report from Cohen and Steers Global Realty Shares Inc. And boy do they have a story to tell about how their investments have performed over the last 6 months ending June 30, 2025. So what's the big picture here? Well, it seems like the real estate market has been a bit of a roller coaster, but this particular fund seems to be weathering the storm with some impressive gains. Let's talk about the fund's performance. For the 6 months ending June 30, 2025, the Class A shares delivered a total return of 770%, which is pretty solid when you compare it to the UPSI High Index Net, which was at 6.07%, and the MSCI World Index Net, which was at 6.07%, and the MSCI World Index Net, which saw a higher 9.47%. So while they didn't quite match the overall world index, they definitely beat their own industry benchmark in real estate. Now, let's break down what drove this performance. A big shout out goes to their stock selection in the US, especially their overweight position in Welltower, a healthcare real estate investment trust. Apparently, their senior living facilities are doing great with high occupancy rates, and they're also making smart acquisitions which really boosted their performance. They also benefited from being underweight in Equinix, a US data center company. This might sound odd, but Equinix had a bit of a rough patch when they released their long-term revenue outlook, which wasn't as strong as expected. So by not having too much of it, they actually came out ahead in terms of relative performance. France was another bright spot with a good market gain and strong performance from retail landlords, and Hong Kong also contributed positively, though it's mentioned it had a tough 2024. But it wasn't all sunshine. They mentioned that being underweight in Switzerland actually hurt their relative performance. Switzerland apparently did really well because it's seen as a safer market during uncertain times. They also had some stock selection issues in Sweden and Canada which detracted from performance as well. And on the currency front, it seems like most foreign currencies appreciated against the dollar, which was good for their overall absolute performance. Let's peek at the growth of a hypothetical $1,000 investment. For Class A shares, it grew to 150/40/25. This means your initial $100 investment added over $5,000 in just a few years, which is quite a nice return. Looking at longer term returns for Class A shares without the sales charge, they had a 10.63% return over the last year, a 5.94% return over 5 years, and a 4.64% return over 10 years. This shows consistent growth over the long haul, though the 1 year was particularly strong. Competitors like the MSCI World Index Net are doing better over the last decade at 10.66%, but Cohen and Steers is holding its own. As of June 30, 2025, the fund has a total of 2,007.46666843 in net assets with 91 portfolio holdings. Their portfolio turnover rate is 31%, which means they're not trading stocks too frequently, which can be good for reducing transaction costs. When we look at their top holdings, Welltower Inc. alone makes up 8.3% of the fund, followed by Digital Realty Trust Inc. at 6.2%. and Prologis Inc. at 4.7%. These are some pretty significant concentrations in a few key companies. In terms of sector diversification, the lion's share of investments is in diversified real estate at 20.3% and healthcare at 12%. This shows a clear focus on specific niche areas within real estate. Geographically, the United States dominates with 62.2% of the fund's assets. Japan follows at 9.1% and Australia at 6.7%. This heavy US weighting makes sense given the earlier discussion about US stock selection. The report also breaks down the performance and costs for other share classes, like Class C, Class I, Class R, and Class Z. For instance, Class C shares, which typically have higher fees, had a 7.34% total return over the last 6 months. Class I and Class C shares, which generally have lower fees and are often for institutional investors, saw slightly better returns of 7.85% and 7.90% respectively. This difference in returns due to fees is something investors should always pay close attention to. Looking at the statement of operations for the 6 months ending June 30, 2025, the fund generated $32 million in dividend income. The expenses totaled about $8.4 million after some expense reductions, which is not too bad considering the net expenses were around $23.7 million. The fund also saw a net realized gain of over $12 million and a significant unrealized gain of over $108 million. This unrealized gain is essentially paper profit on investments that haven't been sold yet, but it's a good sign of increased value. The overall increase in net assets from operations for the 6 months was a very healthy $144 million. This is a substantial positive movement in the fund's value. Now let's talk about the value per share. For Class A shares, the net asset value started at $50.77, and by the end of the period it was $53.89. That's a nice increase of over $3 per share. And that 770% total return we mentioned earlier translated to a gain of $3.12 per share for Class A. The expense ratio for Class A is 1.119%, which is in line with last year. This means that for every dollar invested, about 1.5 cents goes towards the fund's operating costs, which is pretty standard for actively managed funds. Interestingly, the report details their fair value hierarchy. All of their common stock real estate investments are in level 1, meaning they are valued using quoted prices in active markets. Their warrants and short-term investments are in level 2, meaning other observable inputs are used in their valuation. This is good because it suggests their assets are valued based on market data rather than subjective assumptions, though warrants can sometimes be trickier to value precisely. Digging a bit deeper into the company, they are Cohen and Steers Capital Management Inc. and its affiliates. They emphasize that they use security measures that comply with federal law to protect your personal information. They collect information for everyday business purposes and for marketing their own products and services, but they explicitly state they do not share information with non-affiliates for marketing purposes. The report also includes a section on the approval of their investment advisory agreements. The board of directors reviewed everything from the quality of services to investment performance and costs. They noted that the fund outperformed its peer group medians for 3 and 5 year periods, although it slightly underperformed for the 1 year period. The management fees and expense ratios are considered lower than the peer group medians, which is always a positive sign for investors. So what's my take on all this? Well, Cohen and Steers Global Realty Shares Inc. appears to be a well-managed fund that's navigating the real estate market effectively. Their focus on specific sectors and countries seems to be paying off, although it also introduces some concentration risk. The performance numbers are strong, particularly over the longer term, and the expense ratios are competitive. The fact that they are waiving some fees to limit operating expenses is a definite plus for shareholders. However, as with any investment, it's crucial to remember past performance isn't a crystal ball for the future, and the risks in real estate and global markets are always present. What's your take on these performance numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.